Howdy, lieutenants and economists.
The most volatile, evil, disgusting things on the planet, humans. If you have a video request, you can always go to assholeconsulting.com.
Yeah, I am gonna charge you, kids. And that is the importance of not fucking up.
You are such an asshole!
Howdy all, old Captain. Here we got an economics question. Hi, Aaron, former asshole consultee here. I love repeat business with another question. The answer to this question may also appeal to your readers. The question I have is related to the Fed's prime interest rate. If they raise the rate as they have been hinting towards the end of next year, like they were last year and the year before that and the year before that, because everything is awesome. When and how will it impact the rates of personal loans in 2016? Also, do you think the Fed will lower interest rates by the end of the year, or are they just blowing smoke? Yeah, I think they're just blowing smoke. There's really no growth in this economy. And we're like Japan. We have to just keep the rates low, because remember, all economic growth comes from monetary policy and the central bank. It has nothing to do with work ethic or getting educated in the right field. It has to do with low interest. As long as we got low interest rates, deficits don't matter, nothing matters. It's just, we should just have colleges called I'm majoring in low interest rates or ZERP policy. And that's your entire economics department. Don't you know that all creations came from the Federal Reserve? Anyway, no, they won't. They will not. Maybe a token amount, like 0.25%. See, we raised it. But no, it's not jumping to 5% anytime soon. Now, as to address your question about the federal prime rate, which is the federal funds rate, not to be anal retentive. Will that have an impact on personal loans? And then you had questions about credit cards, but you solved it. And the answer is it depends. There are two general types of loans. There are fixed interest rate loans, and then there are variable interest rate loans. And it also depends on what the maturity of those loans are. So if you have a fixed rate loan, like a 30-year mortgage, or a 5-year car loan, or I'm trying to think what a 10-year loan, what would you use for a 10-year loan? Maybe some capital or equipment financing at a company. You have this 10-year fixed loan to pay for tractor equipment or whatever. Those interest rates are not as affected by the federal funds rate. And the reason why is that these interest rates, it's no different than, when you think interest rate or money that has to be borrowed, don't think of it as any different than this cup of coffee or this pen or these sunglasses. The money is the product that wants to be bought and sold. And how do we buy or sell money? Well, we pay interest on it, and we borrow it. That's how we, quote, buy it, but then we return the product, but then we pay for it with interest. So interest is just a price, and that interest rate is determined by the supply and demand, not just for money, but money to be lent out at those specified lengths of time. I'm going to lend money out for 30 years. And there's a certain amount of people who are willing to lend money out at 30. So that's the supply of 30-year lendable dollars. And then there's a group of people, mortgage people want to buy houses, who want to borrow for 30 years. And these two people create the market for 30-year mortgage rates. Then there is 10-year corporate financing for capital purchases, tractors, trucks, computers, whatever. And there's a certain percentage of people that want to lend their money out only for 10 years. There's certain people that want to borrow it for 10 years. So that supply and demand results in an interest rate for that 10 year. And then there's also elements of risk involved, like, for this credit score, for this kind of bond rating. We're going to add a little few or take away a couple basis points here or there. But in general, it is the time match of the length of time that people are willing to lend it out and people are willing to borrow it at that same time. So these longer-term interest rates, it can be as short as 3 years, car loans for 3 years, whatever. These longer-term interest rates are typically fixed, and they are not influenced by the up and down weekly, quarterly, daily changes in the federal funds rate. Now, where it does affect personal interest rates are interest rates that are variable, that are tied to some measure or standard. You remember these, not the HELOCs, what were they called? Variable interest rates. Why can't I remember the acronym? Wrote a fucking book on the damn thing. whatever. You got these variable interest rate, more variable mortgages. You remember, and every 6 months, every year it readjusts. Adjustable rate mortgages. That's what it's. AR. ARMS. Fuck, Clary. Jesus. Where have you been? ARMS, adjustable rate mortgages. Now, it's not just mortgages that have that, and these are not 30-year mortgages. This is basically what they're saying. Let's say you have a 6-month ARM or a 1-year ARM. That means you have a 6 or 1-month loan, and then we reevaluate what the interest rates are, and then we adjust your interest rate accordingly. So, however, it's not just mortgages. You can have credit cards. Those are also variable interest rates. They depend. HELOCs. In banking, we did a lot of commercial lending that was based on Wall Street Journal Prime or the LIBOR rate, which is London Interbank Office rate. I forgot what it was. It's been so long since I've been out of banking. It's great. I'm forgetting this worthless shit. It's wonderful. So these interest rates are determined on very, very short-term supply and demand. Banks, they don't just lend out at 30, 15, or 10 years. And credit cards and other financial institutions will lend. Heck, some will lend overnight, even. Commercial paper, whatever. So the shorter you get, the more volatile the interest rate is. It's like it changes. The interest rate for these, 1-month loan, a 2-month loan, a 1-year loan, a 6-month loan, an ARM, it varies and oscillates depending on the supply and demand for monies to be lent and borrowed out at these specified periods of time. Now, banks, you kind of see this in their balance sheet where they take deposits. Deposits are essentially, they got to pay you interest on the deposits, your checking account, your savings account. And they'll pay you some very low interest rate because they're lending it out while you can always demand your money at any point in time. They're lending it out at a slightly bit longer maturity. So you can demand it at any time, but they're going to lend it out at maybe a year to 3 years. So they constantly have to have this money coming in. They constantly have to, and that's why they charge more what they're lending it out than what they're paying it when they borrow it from you. Because that's all a deposit or checking account is the bank borrowing your money to go and invest it at a higher rate. That's all it is. Anyway, so the point is these interest rates are very, very short. Now, where banks get a lot of this very short-term lending that they then go and lend out to you either in the form of a credit card, an ARM, or something that's more short-term and is variable interest rate loans, is they get it from the interbank market. So what's the interbank market? Well, sometimes banks will have a surplus or a deficit of cash, and sometimes banks don't have anything they want to lend out to, so what they will do is they will lend to other banks. And so, I got a shortage of cash, I'll go borrow from Wells Fargo. You're a U.S. bank, you're a little bit short on cash, you're going to borrow from Wells Fargo. And so you borrow from Wells Fargo. Wells Fargo is going to charge you the interbank rate. You're going to say, hey, we're competitors, we're going to charge you money for this. It's not terribly high, but it's profitable. But what if there's an economic crisis, or what if there's just a dearth of lendable dollars within the interbank system? Well, that's where the Federal Reserve comes in, and we have the federal funds rate. The federal funds rate is kind of like, look, if you banks can't keep your liquidity act together, we'll be here to back you up for a day or two, maybe a month, or in the case of the financial crisis, years. But aside from that, how it's supposed to work is the federal funds rate is the rate at which the Federal Reserve lends out to banks on a very short-term basis. Since the two are very closely tied to each other, in case there's not enough money in the interbank market and then they've got to go to the Federal Reserve, these short-term interest rates are tied to the federal funds market. Not directly, but they do correlate very closely together. And what these are called is you call Wall Street Prime and LIBOR. Those are the two main. LIBOR is more European. Wall Street Prime is over here in the United States. And it really is just a benchmark to say, okay, look, our cost of capital is going to be either on the interbank rate, this, or the federal funds rate. So we're going to take the federal funds rate, add 3% or so to that, and that's Wall Street Prime. Of course, that varies as well. And so as the federal funds rate goes down, and assuming they benchmark it to the federal funds rate, your Wall Street Journal Prime and LIBOR rates also change. This directly affects your variable interest rate loans like your credit cards, your ARMs, etc., commercial lending, HELOCs, all these other forms of debts out there, because they are in turn tied to Wall Street Journal Prime and LIBOR. I remember we'd have it written right into the loan agreement. You will pay us Wall Street Journal Prime plus 2. So not only are you paying the federal funds rate plus the 3% rate that the banks are going to charge on that, you're going to pay 2% more on top of that. So federal funds rate plus 5. Now, as the federal fund rate changes, the Wall Street Journal Prime rate changes, LIBOR changes, and all these other loans that are written in the loan agreement that will also change along with that volatility. So that is the direct relationship between the federal funds rate and short-term variable interest rates that you might see on your credit card or other type of personal loans. How will that impact rates? Now, how will it impact it? Uh-oh, something's going on. How will it impact it? It'll impact it directly. Assuming the banks do pass on whatever increase the Federal Reserve does, which I presume they will. Sometimes they won't. They want to get more market. But it will have a direct impact. It's not going to have a huge impact because the Federal Reserve increasing, they're not going to jump it up by 1%. They'll increase it by maybe 0.25%. And we don't have these, well, we kind of do, but we don't have anywhere near to the extent where everyone had borrowed to the maximum amount on an ARM, on a huge pile of debt called their mortgage. So even a 0.25% increase in their interest rate would wipe them out in terms of their income. I think a lot of people know not to do that now. Banks have also got their asses kicked by the OCC and the FDIC, that they're not making quite as stupid loans as they used to. So I wouldn't worry about like overnight your credit card, your interest rate on your credit card jumping up by 5%. At the end of the contract, they may just decide to say, yeah, fuck it, it's Wall Street Journal plus 20. And they have, that's probably written in there somewhere. But due to the Federal Reserve actually increasing it, no, it's going to be a linear relationship, not an exponential one. So like if it goes up 0.5%, if it's written Wall Street Journal Prime plus, 3, it's going to go up 0.5%. So I don't think it's going to affect people's ability to finance or afford their debt loads because it's going to be small increases. But is it going to happen? I doubt it. I can't tell you what's going to happen in the future. But, just always pay off your interest rate. And like you're talking, I mean, if you got a fixed interest rate of 16%, yeah, go talk to your local banker and see if you can get a personal loan for like 5%. Or go to Lending Tree or any other place, because, man, pay off that fucking debt. You should have debt. What the fuck? You're one of my followers and listeners. What are you doing with fucking debt? Jesus Christ. Anyway, best of luck. Toodles.